Hello and welcome to this Airlie quarterly update. My name is Jennifer Herbert, Head of Listed Funds at Magellan, and today I'm joined by Emma Fisher, Portfolio Manager on the Airlie Australian Share Fund. Emma, welcome.
Thank you for having me.
Emma, 2022 has been an extremely volatile year for markets. How are you approaching your stock selection in this kind of environment?
Yeah, look, I think, first up, it's probably worth noting that for all the angst and for all the headlines, the ASX 200 actually only declined by 1% over the course of 2022, and that's inclusive of dividends. So, obviously that's kind of obscured quite large moves in some sectors. Some sectors and stocks declined 20, 30, 40%, particularly when they were facing that repricing around interest rate rises. So it has been a very, as you say, volatile year. In terms of what that's meant for us and our stock picking, to be honest, when I go back to the few years in the lead up to the pandemic, they were more frustrating years as an investor because you had this ever grinding higher of markets as interest rates ever ground lower. And you'd do all this work, you'd find high quality businesses, good balance sheets, good quality management teams, and then it would fall over on valuation. So, that was more frustrating for us. And so even though this last year has been really volatile and there's been some really sharp moves, it's been a more exciting environment to pick stocks because when you see a lot of volatility, you've got a better chance that some of these businesses have been mispriced. So, I think where we're seeing opportunity, I guess at a broad level, is in high quality businesses where everyone's worried around the cycle. And we don't really take a differentiated view on whether or not we're going into a recession or not. It just seems like the consensus view is that, the macro is very ugly, that globally quite a lot of economies are probably staring down a recession in 2023 or the following year. And we think that narrative has been priced into a lot of businesses. So that's really where we're looking.
Are there any stocks or sectors that you're actively avoiding?
So the first, I guess, criteria that we're pretty wary on right now is debt. And there's two reasons for that. The first one's pretty simple. If you've got a lot of debt, interest rates have gone up, so it's going to cost you more to service that debt, so your profits are going to fall. And then the second one's around operational flexibility. So ideally, at this point in the cycle, you want to have, ideally a mountain of cash that you're sitting on as a business, because if we do go into a downturn, and your competitors are more distressed than you because they have more debt, historically that can be a great thing for the number one player or a business that has more financial flexibility because you can pick up cheap assets or you can win business off competitors that are more stressed. So we really think at this point in the cycle, you want the security of ideally a net cash balance sheet and also the flexibility that gives you in terms of being able to outpace your competitors in a downturn. The other thing that we're sort of wary on is inventory levels. So a lot of businesses, particularly retailers, consumer brands, going into the pandemic, demand was elevated. And as we know, supply chains were very, tight. So businesses put in huge orders in order to get stock. And all that stock's arrived now that supply chains have normalized. So you've got a lot of companies that are sitting on very elevated inventory levels, potentially heading into a softening demand environment, and that, throw in some debt, that can be a really toxic combination of factors. So that's another red flag that we're really looking for in company accounts and trying to avoid in the portfolio.
And the portfolio is typically made up of around 25 to 35 stocks. So it's a very concentrated portfolio of Airlie's best ideas. Perhaps you can share one of those ideas with us, what you like about that stock and what we can expect from it in the coming year.
Yeah, sure. So one that we've added to the portfolio really recently, actually, basically in the last month, is CSR. So CSR is predominantly a building products company. They make about half of their building products earnings through their plasterboard business, so the brand Gyprock. And they also have some other products, bricks, tiles, aerated concrete. And I think it falls into that camp of what I was saying earlier of businesses where everyone's really worried about the cycle. You might be thinking, oh, Emma, you idiot, you're buying a building products company. Haven't you seen that building activity is about to fall off a cliff? And look, I may well be an idiot in doing it, but I think that narrative is really what's creating the opportunity here. So when we go through it, we start with the balance sheet and it is net cash. So, as I was saying earlier, you want to own businesses that are net cash at this point of the cycle. So it's a tick from that perspective. And then actually a huge chunk of the valuation is underwritten by the value of the property, the surplus property that they own. They own a big chunk of land in Western Sydney, for example, and they've had that property independently valued at $1.5 billion, and that compares to a market cap of $2.2 billion. So you can see that, you know, the bulk of the market cap of the business is underpinned by property. So you're actually not paying very much for the building products part of the business. And historically, the market hasn't been willing to pay very much for that part of the business, with good reason. It is a very cyclical industry. And, you know, in a great year like at the moment, they might make a 14% EBIT margin. And in a really bad year, you know, going back a decade, they were making 8%. So there is a huge cyclicality in its margins. And so we think that's the opportunity, because we think while it's still cyclical, we think a lot of that cyclicality might be smoothed from here. There's two reasons for that. The first is their worst business was their glass business, and they've exited that. And then the second reason is they have had Boral exit as a competitor in two of their main businesses. So plasterboard and bricks account for 70% of earnings, and Boral has exited bricks, so it's gone from a 3-player market to a 2-player market, and you'd prefer a 2-player market any day of the week. And they've also exited plasterboard. They sold out to Knauf. So our thesis is basically anytime you see Boral exit an industry, you tend to see an uplift in rationality. Boral historically have been the competitor that you don't want to have, because when activity falls off, they really lean hard on price quite aggressively to try and win business. So we think the industry structure has improved for CSR. And while we expect earnings to fall, and consensus expect earnings to fall, we think, you know, the cyclicality is not going to return to the deep, dark days of the past. So we think, you know, the business will re-rate as we move through the cycle. Meanwhile, that property part of the business, you know, gives you a lot of optionality. It's going to throw off a lot of cash that's really going to smooth you through the downturn. So that's one that we think is an example of a business where everyone's really worried about the cycle. No one wants to touch it. But actually, when you work through it, it's got a lot of reasons why we think it's going to be quite a resilient business.
Emma, thank you.
No worries. Thanks.
And thank you for watching. As always, if you have any questions, please don't hesitate to reach out to the Magellan distribution team, and feel free to share this update with clients or colleagues as you see fit. Take care.